Hello, everybody. Welcome to the Flow Show. It's Tuesday, second day of the week, and we get to see what's going on in the world. Morning, Kay.
Good morning, everybody. Good morning, Ryan.
Hello.
Oh, here he is, the surfboard king. He's back. Good break, mate?
More like the ironing board king. Anyway, all good.
Yeah. Oh shit! Excuse me. I had a little cough
shit.
out.
That was from Top Gun, right?
Yeah.
If you were directly above him, how could you see him? That's because I was inverted. Bullshit. Yeah. Anyway, yeah, all good, mate. All good. How are you guys? Did you miss me?
Yeah. Of course we missed you, mate. Of course we missed you. Like a hole in the head.
We are live. Okay. Yes, of course we missed you, Stelios.
We had nothing to talk about. Absolutely nothing. All quiet on the Western Front, as they say. Well, glad you had a good break, mate. It's nice to get away for a bit, isn't it?
Yeah, absolutely.
Family time, bit of switching off, and probably a big pile on your desk when you get back.
Yeah, no, it's all good. It's good to be away for a bit.
Cool, good stuff. Well, let's crack right on with things. Probably
I don't know if you're sharing your screen, Ryan, but we can't see anything.
That's because I'm not sharing it.
There we go.
Awake yet. There we go. Thank you very much. See, what would I do without you two guys? Crash and burn.
Yeah.
Right, so there we go. Can you all see that now?
Yeah.
Good stuff. Right. Well, Chinese data was hot off the cards yesterday, and all pretty much surprising to the upside. One of the main numbers, GDP, coming in much better than expected, 4.5%. That puts it around closer to what's expected from China, which I think is about 5% from officials over there. So that's coming in better. Not really unexpected to see better data out of there, given the reopening stuff that's been going on these last few months. So expectations were to the upside on those. So not really a big market moving event in the end, even with those beats there. Dollar one didn't do really an awful lot, which was perhaps surprising. Not much at all. Is that indicative of what's going on at the moment, Kay?
Yeah, I think the market is firmly in watching geopolitics as well.
Yeah.
And but the longer it lasts here, the more we are building energy for when the break is going to come. And I was equally surprised it didn't move more than that. It was really very, very shallow move. What was it, like 100 points or so, which is nothing, which is $15.0, right?
Yeah.
So really not much move at all. Yeah, as I say, I mean, the longer this range holds, the longer the more we will be able to look for breaks if it's really going. And this has now been, what is it, a month nearly, or even over a month that we are in this in this kind of range, barring like the quick spike out of it. So yeah, it's about a month. So I think whatever happens, it's going to break, right? I mean, it can't stay here forever. So I'm preparing at least, or the levels are relatively clear. I think 684-ish, another break below is probably going to set some wheels in motion, or a break above 691.92 should provide a decent move as well. Inside the range, I'm not interested at all, because if market is really keeping it here, why would we fight it, right?
Yeah, I think that the market's also got a case of we've seen this show before with countries coming out of virus situations, seeing a positive bounce in activity, and then a few months down the line it becomes, right, well, is this lasting or is it not? And how things going to run from there on. So I think probably the market is looking on the data front, at least probably a quarter or so ahead of itself. Wants to know what happens in Q2 rather than Q1. But like Kay says, fully agree that the geopolitical side of things are weighing heavily in the market's mind on what it wants to do with this one. But anyway, I digress. So looking back at the data, UK data as well, jobs numbers coming in, and a bit of a mix and match on some of the numbers. The claimant count was higher, showing more people making claims, higher than expected and going positive. But then the 3-month rolling employment change was decent, 169,000 on that. Wages is perhaps the standout number here, beating expectations and coming in the same as the month before. Taken off bonuses 6.6%, average earnings including bonuses 5.9%. So that's a little bit for the Bank of England to take into consideration going into their meeting. If you do the old sums of inflation and wages, then wages are still negative. But if inflation starts coming down, that gap closes. We shall see what happens with that, the next inflation numbers coming up. Over in Germany, the ZU coming in a bit worse than expected, 4.1 versus 15.3 expected there. Current conditions not as bad as expected or previous, but still on a negative on that one there. So the data still doing its thing. Some things coming up half decent, some things not. It's still a bit of a mixed bag. Well, crazy, more like a bag of spiders, really. So no real themes to take out of it, apart from the fact that nothing is doing really well and nothing is doing really badly. And that's how it's been for a while and how it's going to continue for the foreseeable, I think. Right, coming back to some of the bank stuff and going back to Japan, Deputy Governor Uchida said that financial restrictions won't undermine the BOJ's ability of carrying out monetary policy. Ueda popped into Parliament and said there's no immediate need to review the 2013 joint statement with the government. As mentioned yesterday, quite a few central banks potentially looking at reviewing their frameworks and whatnot. There's no immediate need, says Ueda. He says positive signs are emerging in prices and wage growth. One might take that as a little bit hawkish, but he has made these comments previously. And they will achieve the inflation target, although it may take time. Now, we do have a little bit of potential weekend risk coming up. There's by-elections in Japan in both the upper and lower houses. I think 5 seats are up for grabs, including Abe's seat as well. The next election is not officially due until 2025, but Kishida's current term as the leader of the LDP runs out, I think, towards the end of this year into early 2024. So these by-elections shouldn't really cause any upsets unless he suffers some big, heavy losses. Kay, you got any thoughts on the state of play in politics at the moment? You know, the LDP party's really out all the time, but I think there's maybe some very, very low, small risk of this one, but it's a risk nonetheless.
Yeah, it's very low, and there's a couple of things going on. His popularity ratings went plummeting when prices were rising, just the same as everywhere. But then lately he regained some. We have to know that the opposition is still very, very scattered around. There's not a big bloc which can, for the time being, challenge the LDP. There is some in the locals, but it's on the islands. Is this some stronger group emerging? But I think it's the renewed or something like the new renewal party or so is emerging. But whether they're really going to challenge anything, I very much doubt it. No, so I don't think there's any real risk now. And as you say, yeah, I think beginning 2024, his tenure officially ends or so. And there's also a bit of rumors flying around that he may actually call for election somewhere in 2024. But I think a lot may depend on exactly what's going on with how the economy evolves and how the BOJ will tackle the task. And coming back to that is that the 2013 agreement, and I've put it in the chat room, is very much focusing on the cooperation between government and the Bank of Japan. So that leads me again to think that that's a bit dovish, not immediately reviewing that. That's a bit dovish in my opinion, as Kishida and Ueda already both said that they will continue to cooperate. So it's a bit of a question now whether he's really going to come out with anything early. As I said yesterday, the opinions are divided even on the ground in Japan. But yeah, it does really seem to be somebody who is going to take it really slow. So for the time being, I would still categorize him in the Kuroda peace column. Perhaps not as dovish as Kuroda was, but still, it's still a continuation for now, right?
Yeah, well entrenched, should we say, in the past hymn sheet at the moment, but it can all change. And back to Kishida, there are some in the market who are saying that if he has a bad showing at this by-elections, that it may lead to a faster snap election being called on that. Still, as we say, very low risk, but we're traders and we need to know where the risks are, low or large. So that's something to watch out for this weekend.
Yeah, who said that? Because the opposite, I would think that the opposite is true. If you have a good showing, you call snap elections, not if you have a bad showing.
I don't know. It's just I've been picking up the comments, various press articles and stuff saying it. So yeah, it can work two ways. If you have a bad showing in a small by-election, you can call a snap election to reaffirm the rest of it. But otherwise, if you've got a good showing, you don't need to as much. But this is politics, so these guys do what they want when they want, and who knows what goes through their heads. But moving away from politics anyway, going over to the RBA and their minutes. And the minutes showed that the board considered a rate hike at the April meeting before deciding to pause. They agreed there was a stronger case to pause and reassess the need for tightening at future meetings. Updated RBA forecasts in May will help assess when and how much more tightening are needed. It's important to be clear that policy may need to be tightened again to curb inflation in a timely manner. Inflation is still too high. The labour market had loosened a little, but is still very tight. So for me, a bit of a hawkish slant to those minutes there. It shows that while banks may go on pause, it doesn't mean they're at the end of hiking. The RBNZ being probably the big case in point. So for trading, if the market looks at these pauses and gets too dovish about them, i.e. thinking that the next move is definitely going to be a cut, that's where there may become a little bit of disparity between what the market thinks and what the central banks may actually do. Obviously, that's all going to be decided by the data. So if we see markets getting all dovish, Fed, RBA, BOE, whoever, but we start seeing inflation picking back up again and whatever, you're going to see a big, quick flip of those expectations. So you've got to be aware of what's going on in the fundamentals, even if you don't follow them strongly, because they are potentially going to be big swingers for central banks and prices. What do you make of that, Stel, if you called it from the RBA? If not, Kay can grab it. Bit of a hawkish start, or
yeah, it's you could say so. I think you're spot on with what you said about central banks in general. If pausing doesn't mean reversing, although that's usually the first step. But markets are very quick to price in all the cuts, especially for the Fed. I mean, it's incredible what's been priced in, and it's a big hurdle now for them to match what the market's pricing. But for the RBA, I think maybe marginally hawkish. It's a bit of a wait and see thing, and I think that's how most central banks are going to play it now. I think pretty much the Fed's going to do one more and then they're going to be pausing. The question is, what happens after that? And we saw today in the UK, we're going to have second round inflation effects, from earnings not. Earnings growth not dropping fast enough. So I think it's a bit premature to say central banks are pausing, therefore they're going to be cutting. It's dangerous to assume that. As I said before, it is the first step towards that, but it's not necessarily going to be the case. So, my view remains that a little bit too much is priced in already, and the doves could get disappointed. I know I digressed from your question, but just putting some thoughts together.
No problem, mate. That's all welcome. Kay, what are your thoughts on that?
Yeah, pretty much the same, right? They are in a wait and see. But we also heard similar from Bank of Canada, that they are in a wait and see, but they are ready to start again. I think that's the message now for the second line of major central banks. Let's put it that way. Not the Fed or the ECB, but the second liners are all a bit in the same boat right now. The one outstanding could still be the Bank of England, as you already mentioned a couple of times, who may be forced to go more than expected, especially after today. But then we also should not be completely surprised by those wage rises, because we know that with all the strikes and everything, the government did give in to some of the wage demands. Yeah, we still have a big one ongoing as well. So those wages may stay on the high side, but it should not really come as a big surprise, right? So, but the rest, the job creation was good. Yes, unemployment rate ticked up just 0.1 on the claimant count change, but I thought this morning's report there was pretty good. As for the RBA, yeah, I mean, the market was probably a bit overly dovish on the Aussie for a while, and then needs to reprice. But that's what we've been saying so many times. The market is, and it's all short-term stuff, right? It's repricing of the repricing, and it just goes on and on and on until we will really see clarity, and we may actually. If you look at it, we may muddle on like this until the Fed comes up again and the ECB starting of May. But then I digress this time as well. But it does look like the market in its constant repricing is a bit losing its way, and there's no big trends, but repricing all the time.
Yeah, boat running, as we like to call it. 1 minute we go on one side, 1 minute we go on the other side, and it's difficult to find the trends in that. Agreed. Over to Norway, and the Sovereign Wealth Fund CEO said the fund lost a considerable sum in the Silicon Valley Bank bankruptcy, which was the biggest bank failure since the financial crisis. High global inflation is still a major concern for us, and we need to be prepared for several years of volatile markets with low and perhaps negative returns on the fund. Now, the Norway Sovereign Fund is the biggest sovereign fund in the world, and they have their fingers in every pie you can imagine. The Ministry of Finance said they will be reviewing the matter of investing in unlisted equities. So a bit of a risk-averse headline there for what they do with the fund. I also saw Norges Bank, some of Norges Bank coming out and reiterating that the NOK transactions they do are for oil are not part of monetary policy. Just a refresher there if you see headlines like that. So the Norway Sovereign Fund finding things tough at the moment, you think?
Finding things tough in what way?
Well, losing money, getting caught out on the stuff.
Pretty much every major fund, sovereign, the pension, the 60-40 portfolio has been decimated, or maybe not decimated, but you know what I mean. So yeah, but look at how they've done over the past 20 years. So you can bet that these These people are waiting for a proper dip to get in, to just keep piling in. That's what they're doing. They're selling their oil, they're converting, they're selling their currency, buying dollars, and then, buying, real stuff, buying equities, buying Apple, buying anything. So, yeah, I don't think they're doing badly. I mean, maybe short term, but overall, yeah, Norwegians.
What about the feed through? Obviously you've got a national sovereign fund. The idea is to earn money for, to pay the bills and run the country and whatever. So if they suffer losses, what pressure does that put on fiscal policies and, maybe even the central bank, to deal with stuff like that? Is it a big thing we need to worry about, or is this just a little blip for them?
Well, the thing is that assume that there is no sovereign wealth fund. Norway are generating surpluses pretty much every year. Let me go back. I have the chart. Yeah, surpluses every year. So, there's no hole to fill. Now, add to that the fact that they have a $1 trillion sovereign wealth fund, which is for a rainy day. So basically, there is no issue. I know I'm talking extreme here, but even if the sovereign wealth fund went down to zero, it still wouldn't be a problem with fiscal policy because there is no hole to fill. No, they're operating really well. And I have a very good friend who's been living in Norway. She's Greek and living in Norway for like 20 years. And she keeps telling me things work so well here. You pay a big chunk of your income in taxes, but then everything is perfect. So, if it wasn't for the bad weather, I'll be living there too.
But, I mean, hey, with global warming, that's the way to look, north, not south, right?
So I don't see Norway. That's why I love the kroner in the, as a medium-term trade. And, when it gets really punished like it is now, that's why I really love that as a long. So buying kroner against, euros, dollars, whatever, because the countries run so well. The only problem with the currency is the central bank just selling the crap out of it. That's the thing. So, I don't think there would be a problem, even if, the wealth fund went down, 30%. I don't think there would be a problem anyway.
Yeah, definitely. Thanks for that, mate. Good information there. Just gives the viewers an insight into what happens over there in Norway with, as I said, one of the biggest or the biggest sovereign wealth fund in the world.
Yeah, and as our friend Angela says, no water shortages either. Yes, absolutely true.
Yeah, or snow, or bears, polar bears, eating the rubbish. Right, coming a bit further south to the Eurozone, and yesterday the market gauge that's looked at for Eurozone inflation expectations on the longer term hit the highest since March 7th. That was at 2.4939%. Now, obviously, inflation expectations is a big part of the ECB mandate, and that's something they'll keep an eye on closely to make sure that things aren't becoming further detached or more detached on the expectation front for inflation. And speaking about inflation, Lagarde was out waffling yesterday, and she said that they can discuss changing the 2% goal once the inflation objective has been achieved. So it's another comment on potential changes of frameworks between the powers that be and the central banks, but no change there from the ECB until the objective has been achieved. Looking at back to the Bank of England, and a Reuters poll showed that the BOE will raise rates by 25 pips to 4.5% on May. So 33 of 61 economists, with the balance saying they'd go on pause. So 33 to 28, fine line of expectations there for what the Bank of England will do at its May 11th meeting. Back to the data, and Empire Manufacturing yesterday came out very strong. This one's been a bit of a mess of late. It was the first uptick in 5 months, or first positive number in 5 months. As you can see, there was expected to come in at minus 18. It came in at plus 10.8 from a minus 24.6 prior. On some of the components which are not listed on that calendar, Prices paid came in soft at 33 versus 41.9 prior. Employment was better, but still a negative at -8 versus -10.1 previously. New orders did a lot of the heavy lifting in the positive number, coming in at +25.1 versus -27.1 prior. So a big switch around there. That also has added a bit of positivity to the fundamental picture in the US, that things aren't yet ready to collapse. Though, as I say, this empire has been a bit volatile late. It's been up and down and missed and beat all the way through. We get the Philly Fed as the next number coming out before those flash PMIs on Friday. So we'll keep an eye to see how the rest of the data comes out from that. Fed Barkin says he wants to see more evidence of inflation settling back to target. That was all from the Fed yesterday, nice and quiet for once from them lot. On the geopolitical front, German Foreign Minister Baerbock said Europe won't look away if the Taiwan situation escalates. Bit of a difference in comments from Francis Macron, who a couple of weeks ago, when asked about it, said that it's not automatic that Europe will follow the US into any conflict with China over Taiwan. So we are seeing a bit of a pickup in headlines again about all this situation. Yesterday, China said they announced they were doing some major military action in the Yellow Sea today. That's been confirmed with some drills that they're operating around there. Taiwan is said to be buying 400 US anti-ship missiles, supposedly to repel a China invasion, and that got the Chinese Foreign Minister Wang saying US weapon sales to Taiwan hurt peace in the Strait. It seems, guys, that we're seeing a China, Taiwan, Russia comment dropping every 5 minutes on the wires now. Is this a bit of a pickup in these sort of headlines? Do we need to be worried about it?
Well, yeah, there's a lot to do about those visits of the Taiwanese prime minister to the US, and then a lot of it is in retaliation. And then you've got this double language from the Chinese, and then if you listen to the Russian comments earlier today, then they are now really joining their military intelligence and nearly forces to do drills. And I still think it's a big risk. But I mean, okay, let's all hope it's not going to get to anything really bad. But in the meantime, we can't look the other way, right? It's there, and there is a risk. The problem with all these things is that there's a risk of an accident or a miss push on any button, and the shit hits the fan, right? So that is the most worrying thing, is that for as long as it stays, the drills are actually pretty strong and pretty hard of what we've seen. And then Russia is now said by some intelligence forces that they may be ready to use whatever is available to them to try and sort out the Ukrainian situation. So I don't like it at all. At all.
It's one of those things. It's difficult to trade because it's gonna be, like you say, it's gonna be a headline drop. Something's gonna happen, perhaps, like say an accident or a headline that our friends at Bloomberg take and twist around a bit. Wallop, you've got a big move on your hands, particularly in risk. But there's also the amount of headlines that are coming through. As I say, even sitting here the last few days, it just seems like there's more and more headlines of that ilk coming out, and that can be a worry for the market if they see too much, if they get too concerned that things are picking up. Suddenly, players can just say this risk is growing too much. We're just going to get out of certain risk assets, and then you start to see a bit of a. I won't call it a flash crash, but you start to see some sharp moves where people go, enough's enough. I don't want to be sitting watching all these headlines. I'm going to get out, and that leaves a bit of a contagion effect and a big rush to the exits, if you like. So there's not a lot you can do about it in terms of trading it. and jumping on a headline like that. But if you're in trades that are affected or can be affected by risk, like the yen, like Swissy, like gold, you need to keep a strong handle on your positioning and on your risk. Make sure your stops are in place. You don't want to get a headline that and you're not got a stop in place and you're suddenly 200 pips, 300 pips offside on a flash move. Conversely, if you make profit from something like that, don't look the gift horse in the mouth. If a headline gives you something like that, take some money off the table, leave a little bit on to see what happens after, but take that gift that's been given to you. The market doesn't give them often, but it's very happy to take them away from you. Moving over to the US lastly, and US House Speaker McCarthy says the House is to vote in the coming weeks on the bill to lift the debt ceiling into next year. The other House, the GOP debt ceiling, GOP says the debt ceiling plan is coming tomorrow. So this is a plan to kick the can another year down the line on the debt ceiling. If that happens, that will fall off the market's radar until next year. If it doesn't, if there's trouble getting these votes through and kicking that can, we still creep towards this June deadline where something has to be done, or we end up with shutdowns again from the US government. That's all I've got, guys and girls. Anything you want to add that you've picked up on that I've missed?
Not really. I have just a comment about what you were just talking about regarding China and Russia and the potential of conflict and all that. I would argue that the more headlines we see, the more the market becomes numb to them. and you know, I think everybody knows that if there is any kind of proper conflict involving China and the West in any way, it could be, you know, it could be the last conflict on earth. So, and, you know, until there is a fat finger somewhere or somebody makes a mistake somewhere, I don't think this can ever really escalate to a proper, you know, East versus West conflict, because we all know that nobody's going to win after that. And our trades are not going to matter at all when everything is getting destroyed. But yeah, I personally, you know, I look at the headlines about China and then Russia, and oh yes, we are doing exercises together and this and that, and I'm like, yeah, whatever, you know, they are. I know it sounds a little bit stupid to say that, but I think it's part of all, you know, in this big international chessboard. They're playing the little moves, they're trying to they have some goals that they want to meet, and they use power here and there to try and get something tit for tat. You know, I get this, you get that. You know how it works. So I don't think we're going to get a climax of some sort, not a proper one anyway. But you know, definitely worth looking at the headlines. But I've just become so numb to them. I'm like, yeah, well, okay, whatever.
No, I agree with you, and the market has been numb to them for many months. But I think, you know, we've talked about it recently. You know, something like gold and, you know, what's happening in the yuan. You just get a feeling. I mean, you know, it's like you get these feelings being in this market long enough that things are moving not due to fundamentals, but perhaps due to the risk side. And you're right. The more headlines you get, it can become numbing. But that's on the other side. The fact that there are more headlines show there's more going on, and as Kay says, raises the risk of accidents happen. If you're getting drills happening every week instead of every 3 months, 6 months, that's a step up, and it increases the risk of something happening. But there's not a lot we can do about it. If a headline drops, and we have to react and hopefully make sure we're covered either way. So yeah, Kay, got anything you want to chuck in, or shall we move on to looking at some charts?
No, just the start of the earnings season is much better than the fears. Looks to be a recurrent feat. Last time as well, people were warning about the earnings. Most of them beat. Now I've read something BOA overnight saying that it's the best earnings season compared to expectations for the past decade. So that's keeping risk well bid right now, especially on the equities. We've seen these equities going up at the same time as US yields. That is putting a bid under whatever is risk related right now. But there's more coming out this week. So and less of the bigger names as well. Starting to show. So perhaps we'll have to monitor that as well. But that's about it, mate.
Yeah, and I was chatting to Michael Brown over at Old Pepperstone this morning, and he pointed out that European equities are doing far better than US equities at the moment, which sort of bucks the trend over there, at least, that a central bank hiking is going to be bad for equities. And if they turn dovish, that's going to be good for equities, because equities are still going up over there, even while the ECB are going full on hike at the moment. Or is it a case that people are seeing a better performance in Europe than the US?
Yeah, no, I think there was a lot of fear last year that Europe, due to Ukraine and everything, was going to go half bust because of prices and energy and stuff. And I think what we've seen, and it's been going on for about a month now, is a kind of rebalancing between equity markets and asset markets. And we've seen EU yields doing better than the US. We've seen DAX, CAC and getting to record level. I think there's more a fact of a rebalancing than really interest rate expectations right now, because, as you say, it's a bit counterintuitive if you expect the ECB to raise more than the Fed to go and buy European equities. But I think it's just a rebalancing on the base of economic activity, economic indicators, fear of the worst being over, and stuff like that.
Yeah, definitely. Ali, yeah, I did see your earlier comment, and I will be happy to comment on that. I'm not sure about your risk reward. You're risking 40 to make 30. So on that front, risk reward isn't something I use, explicitly to plan my trades. But you're in at 67.28. You got your 88 stop. Yeah, I think if you get your profit target, I'd say why take it all off? Why not take some of it off, bring your stops up behind, and see if you can ride it for a bit more and improve that risk reward ratio. Try and push it right up. When I'm trading those sort of short term trades, I like to try and push them as far as they can go. And there's nothing wrong with taking a bit of profit off. Even if you give a bit back, you've still put some in the bank. So you're still going to make money either way. You just might not make as much. But on the other side, if it goes through your profit target and keeps on going up to 68, you're going to make exponentially more. So yeah, not too keen on your risk reward side, but profit's profit any way they come. But yeah, it's looking solid off this. I would have liked to have seen 67 holding a bit stronger, but it got down to that little traffic zone we've got down there, held, and the bounce has been helped a bit by the RBA as well, and probably those China numbers, as you say, lifting Aussie fortunes a bit. But we're a bit in the middle here at the moment between what we saw at the highs and down at these lows. So it's 50-50 where it can go from here. But if you're in profit, as I say, nothing wrong with taking some and locking the rest in. Dollar yen, keeping an eye on closely as always. We had a little bit of a move above this former resistance zone, the top of this band that we've been watching for quite a while. Did a little break out the top of this channel that we're doing, but couldn't hold it. We're back below, keeps us in the box for now. I think this 134, 133, 70, 80 area is going to be important. If we can hold above there, that's going to keep the upside momentum in play. Back below there, then perhaps we're looking at something a bit deeper. If this trend is to start breaking, it just needs to stop the series of higher lows that we're seeing. So 132 is probably the big number down here at the moment. We've not got too much data out today. Housing starts and building permits, so housing numbers coming in there. Going to be interesting to watch what happens with that, just in terms of market reaction, if it's a good number or bad number, depending on the variation. Just to see what mood the market's in again with data after the bit of a mess we had from Thursday, Friday last week. Dollar CAD. This one is a bit of a missed one because I've been watching this pattern for quite some time, and we pretty much hit the bottom of it after the break of 135, right bang on the 133. This trend line here, we've been moving between the goalposts, as this pair can do nicely from time to time. I'm thinking 135 potentially is going to be resistance again up here if we do hold this move below. We do have Canadian inflation data as well today. Let's just give that a little flick up so you can see what's coming from that. Oh, where are we? There we go. So there are 50 ways to try and counter inflation. These core numbers need to be watched. Looking for a small drop on those core numbers. Headline CPI looking to come down to 4.3% from 5.2. So a big hefty chunk is what's looking at for there. Obviously for the Bank of Canada and for the loonie, watch to see if it's doesn't come down as fast as expected, or even if it goes close to what it was prior. That's going to probably push some hawkish expectations into the loonie on that front. What are you guys seeing any of this? I know, Kay, you're looking at loonie now and again, walking nicely on the techs at the moment.
Yeah, it does. We were looking at that 133-ish the other day. And interesting is that the CPI this afternoon may be of some importance, because if that drops below 4.5%, their monetary policy interest rate is right now at 4.5%. So that is going to be an interesting watch this afternoon. So I reckon the Canada this afternoon is prone for a move. It's going to be relatively important what's going on there. I also think because of their interest, where their interest rate is right now at the Bank of Canada.
Yeah, and we do get Macklem and Rogers speaking at House of Commons Standing Committee later as well. I think probably talking on the NPR report at the last meeting, so we may get some further comments there.
Yeah, the Cats would be a mover right today.
Sorry?
The Cats should be a mover today.
Yeah, so one to keep an eye on definitely later. All else equal, euro dollar has had it had its. I was looking for this 30 area to see whether it held up. It didn't. It went through, not by much, one should say. Let's get a clear look at the chart there. But we have held on to the big figure down here, which is, again, it keeps this whole move in play still. So we'll probably have to see what's going to happen between 109 and 110 at the moment. It's going to need to get another move back above 110 to keep this alive, keep those highs in sight for maybe another push up. Probably going to expect to see resistance coming in around this this old former high, which marks that fib level, which goes back to there. The fact that it didn't last usually means that we're going to see it coming in as a level again. And in fact, if you look at the short term, you can see it was resistance. We had the break, then we came back below, then it was resistance again. So it's re-established itself again. So for me, 110 needs to be taken out, and then that 110.30 before we think about getting a move up much higher back to these highs. And on the downside, 109 maybe down to 108.90 factor in the mix before we get back down to this traffic zone again. It will need to get below 108.30 and this prior low to look like it's breaking the uptrend that we've seen from the 105s. Kay, did you want to take a little look at anything?
Yeah, unless Telios is already up and running, I'll grab just a couple of things.
I'm getting back to speed, mate. Maybe tomorrow I'm gonna.
Okay, no problem at all.
Yeah.
Okay, since we have those CPIs in Canada, let's look at let's focus a little bit on the Canadian dollar then, shall we? Right. So this is where we stranded, roughly where Ryan was showing as well. There's a couple of trend lines coming in there. So we can see that the 133 is really going to be important. There's a few levels below, but I've already said that if we break again sub 133 on today's data could be important enough. So there are a few levels for confirmations below 132 3/4 if you want, 65.75. But if we break back below 133, I reckon the 132 1/4 here will be retested. That's the going all the way back to November. That should be retested if we break sub 133. And it's also a springboard for when the big move up to the highs unfolded. So this 132 1/4 is going to be the next very important level. And if you see, we have to go back to the more medium term if that would break, and there's a bit of a vacuum there. So I'm not seeing, it could be a real accelerator if ever that gives way. Now on the other side, yeah, that means if CPI comes out, let's say weak enough, I guess we are going to have a breakthrough that yesterday's level. If 134.30 goes, then I reckon there's another probably 1% or so to be monitored before this prior high around 135.5. There's a bit of a trend line here coming in that was broken, retested, and from where we saw the move back down. So watch if 134.30 goes, I'd say watch that 135. There's a bit of a fib here, but I think market will be eyeing around the 135.5 level. So that's those are the points to watch. It's really going to have to be a very weak one for this one to break, I reckon. So keep a close eye on what's happening here. But I think in the current context of events, it may just be enough if we rebound. EuroCAD is moving along this trend line, and again we can see this 146.40 popping up every time the EuroCAD tries to make a move. It seems like an obliged crossroad to get back to 146.40. So this is the one that we are looking at again. Allow for the odd 10 or whatever pips, algo pips through it if it would hold or break. But if it breaks, then I reckon there's probably a chance to see it back around perhaps low 145s into the high 144s. Again, is today's number having enough power to bring it down to the bigger zone in the 144.5? I'm not sure. I'm really not sure. Top side, watch this previous little high here, and it's also a trend line. I know it's been traversed a lot of times, so this has been watered down, this trend line. But anyway, the 147.5 is a level that we should look at. And if that would go, then we're talking again about 148. Really, if in the context of the euro still doing pretty well, this could be, if really the Canadian CPI starts to slow, this could be one that has the power to get back to high 148s. Why not revisit those highs in March here? Because the market is still, and as we've already been talking about those equities as well, this rebalancing. Although I found it losing a little bit of steam, the market is still in a pretty positive mood on the euro side right now. So if really the Canadian CPI would start to really materially slow down, I think this one may have the power to break up and revisit higher. And then there's this one, the Canada yen. It's been this is also a trend line of a channel. We did retest the underside of that channel and then bounced pretty fiercely. We are now in a very interesting zone here. And we have seen that this trend line always had some sort of importance. So I would again not completely rule it out. So a hold back below, it's 100.10, but call it 100, would be looking as a bit of a failure. Also because we wouldn't have been able to tackle this 1003/4. If again there might be a bit binary this one. But if we fail to really tackle this 103/4, this may start to look as a little bit of a failed attempt, and why not see it lower? But therefore, we should see a materially slowing in the Canadian CPI. And as we've seen elsewhere, the CPI is coming out elsewhere. It's not a given thing. It's very uneven right now. We have seen the south of Europe CPIs coming out, which really materially slowed, but then other ones remaining very sticky. So it's not a done thing, but this one has the potential of a move as well, especially when we are looking at the dollar yen as well. I've stolen your trend line, Ryan, because I didn't have that one yet on the top side.
Oh, terrible, terrible.
Sorry?
Terrible, all this theme going on.
But it coincides with a 61.8 retracement as well of the move down from 138 to the latest move lower. So we stopped right there today. So that's a level of interest for sure. And just a quick one on the daily, and I'm going to zoom in a little bit just to show you the top of the cloud lies at, again today, 134.47. And look, we haven't had a close above yet. So this zone, call it 134.45.80, is pretty important enough, I would say, for the next direction of the dollar yen. And it's actually starting to really reject that level now, because we're trading back at 134, the figure. So on the downside, keep an eye on what's happening here, because this trend line here had been broken on the way up. It's around 133.75. I'd say keep an eye on that 133.75 as well, because it's the level from where the last leg of this up move started. We halted around there on Friday. And then yesterday and this morning we pushed through, and now starting to reject. So keep an eye on what's going on at 133.75 for the dollar yen. If that would go through, then we are probably talking about 133 will be, but then this bigger zone, which Ryan also mentioned, in the low 132s, mid 132s to low 132s, it's always going to be one to watch, and especially this one here, because we've printed higher lows. If that starts to go, then there may be a lot of pressure here on whatever happens in the 131s in the dollar yen. So that for the dollar yen, and a little bit in the light of what could happen with the Canada yen as well, because it's not only the Canada that plays a role, but the yen as well. Euro yen, really quick. I've played it, as people know, I've played it to the long side for a while. And today I decided to go out of it. It's just because I didn't particularly fancy the speed of the follow through. And then the zoo, actually, even though it didn't have an impact on the euro dollar for more than 10 points, I just decided to get out of it, because it could be a bit of a not a reach, but a slowing down of the move, you know. And I wouldn't really be surprised if we're going to retest at least this prior high in December. So for the time being, I'm in a wait and see attitude on the euro yen. Cable quickly. 124.40.50. Hello. That's the same level as we're seeing on the euro CAD on the 146.40. It's an obliged passage when the cable wants to do anything. It's always having something to do at 124.40.50. So I bought it last night, not too far from here, as people know, in our room. I was planning on buying more around here, but then didn't get it. But I've been managing a fair bit of it already now that we're back at 124.40. Not 100% sure what's going to happen in the US afternoon, but if the dollar continues to show a little weakness, I think there is a fair possibility that this goes back to closer to 125. Not sure, with all the data still coming out this week, and today it's still quiet, but from tomorrow the data really accelerate. So I'm not 100% sure what's going to happen. So I prefer to trade the range, but as I said prior and on prior meetings and flow shows, I'm still relatively positive towards sterling. My bias remains mildly positive. Let's put it that way. Lastly, and then I'm going to give it back. Euro sterling still very much in the channel. Yesterday we had the test of the prior high, failed, and then we went back down to closer to the 88.10 zone. We had a bit of an attempt to go lower on the UK employment report this morning, but it's still valid. So that's your range right now. I wouldn't really think too much about it, other than trade those techs, because I thought sterling should have been doing a little bit better, but then the euro still has enough strength to bring it back down to the middle of this, to bring it back up, sorry, to the middle of this of the little inside range. If we start to go back below 88.10, then there's probably good enough break here to go and revisit the mid 87s. But first things first, or just observe what's going on inside this channel or range, really. And I reckon for today, this is it, because I'm looking at the clock. We are already very close to 11:30.
Yeah, thanks, mate. Thank you very much. Yeah, just a quick comment. We were laughing and joking about stealing techs and trend lines and whatever. There's nothing in that. The great thing about being in a community is that sometimes other people see things that you don't. And it's very important for trading. You know, you can look at a chart and think, oh, that looks a certain way, and someone will come up with a trend line or an indicator or something they're looking at, different time frame, and the picture looks completely different. So when you're trading, you know, having a community that can see that for you and help you along with your trading, it can be the difference between not making money and losing money, or actually making profit because someone's seen something you haven't. So there's no such thing as stealing, and from that, I'm going to go and steal everything off Kay's charts from now on. But anyway, thank you very much, guys. Kay, Stel, welcome back, and thank you to all our viewers for coming to the Flow Show. Have a great day, and we shall catch you all tomorrow.
Thank you, guys. Thanks, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.